Oh, hey, how's it going, everyone? My name is Amos, and not in a million years that I think I was going to be looking at and contemplating an oil company on this channel. But that's exactly what we are doing today. This past weekend, I was researching and trying to find undervalued companies in the stock market. And lo and behold, I stumbled upon Murphy Oil Corporation, what you see on your screen right now, ticker symbol MUR. Year to date, they are down by negative 21%. The PE ratio is sitting at an 8. The dividend yield is 3.5%. So in this video, we are going to be looking at the intangibles, the finances, and run some valuation models to determine if this company is disgusting, smelly, and ugly, or if it's a hidden, undervalued gem, a delicious dividend stock. Now, Murphy Oil Corporation was founded in 1944 at the height of the oil boom during World War II when we were fueling our fighter jet planes and tanks. And Murphy actually started out as a gas station chain around the South. And then they built an oil empire with offshore drilling and extracting oil overseas in places like Malaysia, Congo, and Canada. And because of their success, they started to publicly trade in 1956, which is around the year my dad was born, which kind of tells you my age. I'm in my mid-30s. And if you're from the US, you've probably seen a Murphy USA gas station before if you've driven past a Walmart. And believe it or not, that used to be a part of the Murphy Oil Corporation, but they had a spinoff, and I'll talk more about that here in a little bit. So this is a channel that is focused on dividend compounders, right? That's what I like. That's my preference. So the first metric that we're going to be taking a look at is their dividend profile to see what we're working with. So what you see on your screen right now is the free version of Seeking Alpha because I'm too cheap to pay for a subscription. But anyways, their dividend profile, as we mentioned earlier, a 3.5% dividend yield, which I think is good. It's not too ridiculously high and it's not too low like Costco's dividend. But anyways, for each share of Murphy Oil that you own at $33 a share, you get paid $1.20 in dividends. The payout ratio is astonishingly low at 27%, which tells me that the dividend is sustainable. And they've been growing this dividend for the past 5 years at a rate of 3% year over year. But when you break that down, they've only been growing it for the past 2 years. Let's take a closer look at their dividend. So back in 2014, the quarterly dividend payout was 31 cents. And then as we fast forward, they were increasing it, and then they ran into some headwinds and they cut their dividend. And then the pandemic happened, which meant the economic production all around the world was decreased because of a contagious virus going around. And as a result, they had to cut their dividend even more to 13 cents every 3 months. But since then, the economic production around the world has been picking back up, and they have been increasing their dividend quarter after quarter. So one thing that I can tell right now on surface value is that Murphy Oil, especially their dividend, is correlated and tied directly to how the economic conditions around the world happen to be. Like if things are doing well, then Murphy Oil is doing well because it's directly tied to selling oil to companies that need it to run their logistics, their trains, their trucks, their planes. But during times of stress and turmoil, it does look like Murphy Oil does go on the dip, especially their stock price and their dividend. So based on their dividend profile, it tells me a few things. Number one, their dividend payment is absolutely sustainable by their very low payout ratio. But they also have cutting dividends as a part of their DNA. It's a part of their history. So those are two things that I do want to be mindful of. And number three, they are back on the uptick of increasing those dividend payments. So all in all, if I were to give a grade to their dividend, I would say something around a C. It's not the greatest thing in the world, but because of their history of cutting dividends, I have to deduct some points from them. But anyways, I don't think that warrants a red flag to be raised. I think as of right now, it's kind of beige. So I do want to keep investigating this company. The next thing that I'm going to be taking a look at is their adjusted stock price history and their total return performance. So for the past 365 days, their total return has been negative 24%, which is not too good. But let's go ahead and zoom out and look at this company from a bird's eye view. 5 years out, then we're talking about a 79% total return, which is not good, but it's not bad. It's about average. And then when we look at Murphy Oil 10 years out, then it's a negative 15%. And when we zoom out to 15 years, 11% total return. Meaning if you had invested into Murphy Oil 15 years ago, your money would have grown in that entire time duration and time span only 11%. But if we zoom out to 20 years, please tell me this is going to be a better picture. Okay, a 65% return. So what this is telling me is that this company is very cyclical. Sometimes it goes up, like back in 2008, and sometimes it goes down, like during the pandemic, and it goes down by a lot. So right off the bat, I can go ahead and label that Murphy Oil is most likely not a dividend compounder with cheese. Because if your money is going to be relatively flat for 15 years, that tells me this is not a compounder. But I don't want to end the video right now, so let's go ahead and move on to the next metric, which is going to be their top line, the revenue. And when we look at the revenue, something that we have to be mindful of is that back in 2013, they had a spinoff and they split the company into two separate organizations, resulting in Murphy Oil Corporation, and number two, resulting in Murphy USA, the retail segment of the business, the gas stations. That's why their revenue declined so heavily. So as a result, we're only going to take a look at their revenue past 2013 and start in 2014. Okay, does that sound fair? So back in 2014, they posted $5.3 billion of revenue in the past 12 months, not according to their own fiscal calendar, but for the past 12 months. And when we break that down into a quarterly standard of the past 3 months, it was $1.2 billion. And as we fast forward throughout the years, you can just see that Murphy Oil's top line, which is the revenue, what you want to see in a company to be growing year after year, is just constantly going downhill. They're pissing me off. I don't like this company already. But in 2018, they started to rebound a little bit, and then it went back down. So remember, in 2014, they posted around $5 billion, right? Have they ever been able to meet that metric again? No. At the height of the pandemic, March 2023, they posted $4.2 billion. So they were shy by $1 billion from one of their better performances right after the spinoff. So Murphy Oil's revenue being flat and on the declining trend every 5 to 10 years or so, not good. Next up, we are going to be looking at their net income. This is what investors refer to as the bottom line, the net profits. Hopefully this is a better picture. Just like the revenue, we're going to take a look at it after 2014 because of the spinoff. So back in 2014, their bottom line was $900 million. And as we fast forward, oh my goodness, this is an ugly picture. They were negative in 2015 and in 2016. Not good. And then again, they were negative during the pandemic. Okay, well, that one we'll give them a pass because during the pandemic, a lot of companies were struggling. But since then, they are on the uptrend and they're doing a little bit better now. But just like the revenue, relatively flat, and they show signs of being cyclical. Every 5 to 10 years, they do go down. And in the case of their net income, they even went in the negative. This is not a pretty picture so far, friends. The next one is going to be the free cash flow. This is not a GAAP standard, meaning this is just a metric that investors look at that's kind of subjective in how it's even calculated. But anyways, what we want to see is their free cash flow going in the right trend or increasing year over year. And in the case of Murphy Oil, just like their revenue and net income, it is inconsistent. Sometimes it's down in the negative, like negative $1 billion, and sometimes it's positive by $1 billion. And last but not least, let's go ahead and look at their shares outstanding. Essentially, what you want to see is a company buying back shares, which means every share that you own has quality over quantity. Because if a company is constantly issuing new shares to raise capital, then the amount of shares that you own, the power that you have, is diluted. It's not a good thing. So let's see if they can do anything right. So back during the Great Recession, they had about 192 million shares outstanding. And then the spinoff happened around 2013. And then they've just been buying back their shares year over year. For this chart, what you want to see is an inverse relationship. You want to see it decreasing year over year. Unlike the revenue and the net income, this is actually a good and a pretty picture to see. So at least Murphy Oil understands the assignment that if they can't grow their revenue and can't grow their net income, they better be buying back their shares because their PE ratio is a freaking 8. A single digit of an 8. So at least they understand and they're buying back shares. So it kind of reminds me of Altria, which is another company that I absolutely hate and despise, yet I have a lot of money invested into Altria, and they're doing the exact same thing. They understand the assignment, and they're also aggressively buying back shares. So finally, there's something that Murphy Oil is doing right, and it's the fact that they are buying back shares almost every single year, except during the pandemic. It looks like they paused, and then they issued about 3 million shares, but nothing too crazy. But it looks like if history is an indicator of anything, they are going to buy back shares. And I just looked at their earnings report that was posted about a month ago, and they are buying back shares, which I think is a perfect segue to take a look at their most recent earnings report, Q2 of 2024. Let's go ahead and see what happened. So it looks like in this past quarter, they repurchased $56 million of stock. So they bought back 1.4 million shares, which decreased the float by 1.4 million shares. So remember what I said earlier, they are going back to the trend of buying back shares. And that's why looking at the history of a company is really important so you can predict and forecast what they're going to do in the future. I know a lot of booger heads like to say, oh, past performance is not indicative of future gains. And yes, to a certain point, that's true. But on the other side of that, the past history tells a lot about how a company deals with adversity, what they do when times are hard. Do they cut the dividend? Do they sustain the dividend? And what they do to bring back value to the shareholders. Do they buy back the shares? Do they issue more shares? Do they try to acquire and merge with another company, etc.? But in this case, they bought back 56 million shares at an average price of $41 per share. My friends, that's not a good deal because they're currently trading for $33 a share. And at $41, the board of directors and the executive leadership team, they thought that it was undervalued enough to buy it back at that price point. So at $33, that tells me as a potential investor that this company is absolutely undervalued or a dumpster fire. But how was their Q2 earnings? Well, the estimated EPS was 73 cents a share, but they reported 81 cents a share, and that's because they were buying back the shares. When there's less shares outstanding, that improves a company's EPS. And then for the revenue, this is where they missed. The expectation was for $813 million. Instead, they posted $801 million. So they missed the revenue, but they hit the EPS. So their Q2 earnings was half good and half bad. And before I forget, check this out. Subsequent to the second quarter, what's going to happen next? They're going to repurchase 1.1 million shares at an average price of $38 per share. Remember, it's trading at 33 right now at the time of making this video. And the company truly believes that the stock price is undervalued right now because they increased the share buyback plan by $500 million, which means they still have $800 million in the reserve of field artillery ready to make it rain to buy back $800 million worth of shares. So artificially, this company has the potential to inflate in their stock price through these share buybacks. So that's something that I do want to be mindful of. So the Q2 earnings, about average, right? It's a C. They hit the EPS, or actually they exceeded the EPS, fell short of the revenue expectations. But this share buyback plan right here, it sounds pretty good to me, as long as they can afford it. And by doing a quick spitball high-level look at their balance sheet, for the past 12 months, they do have about $333 million of cash and cash equivalents on hand. Their total assets is sitting at $757 million. So with this plan of $800 million, sounds a little ambitious. And when we look at their cash flow statement, it looks like right here for the past 12 months, they spent about $281 million buying back shares. And their free cash flow right now is sitting at $941 million. But something I do want to be cognizant and mindful of is that they're not going to spend all $800 million in a single quarter to buy back shares. What it means is that they have $800 million to spread for the next, 8, 12, or 20 quarters to keep buying back shares as long as they see that the company's stock price is still undervalued and as they see fit. So based on their pattern, trends, and behavior, they're probably most likely going to buy back like $40 to $60 million worth of shares each quarter, as long as it stays in the ballpark of like $30 to $40 a share. Now that we've got all of that out of the way, let's go ahead and talk about Murphy's business model and if they have an economic moat. What is their revenue source? Pretty simple, oil and gas. But to truly understand Murphy Oil, we need a crash course on the oil and gas industry. So the industry is broken down into two avenues, upstream and downstream. And as you can see on your screen right now, it says what? Murphy is an independent exploration and production company. So exploration and production falls under the category of upstream. So think of a company drilling and pumping oil from the earth, or if you're a visual person, think of a treasure hunting pirate, right? That finds oil and takes that oil. Then they sell that raw, disgusting, and smelly oil to refining companies and commodity traders that are in the downstream side of the oil and gas equation. Downstream is when a corporation refines raw oil into usable products like car gas, jet fuel, and diesel, then selling it to consumers like at a gas station. So if you are a visual person, I know that made a lot of sense, but if you still don't get what downstream is, think of it as like a kitchen chef that takes raw ingredients that turns it into a dish that you can order off of a menu to eat. You're not going to order a raw onion or raw tomato sauce, but you would order a spaghetti. So now that you understand the difference between an upstream and downstream oil and gas company, Murphy Oil is an upstream oil company, meaning they spend their resources and efforts in finding more oil around the world. Because remember, they're treasure hunting pirates and harvesting that said oil. Conveniently, they can sell their raw oil to Murphy USA, which is a separate company in the downstream business. Remember we talked about it earlier, I alluded to it? Just in case you weren't paying attention, Murphy Oil and Murphy USA used to be the same company, but they had a spinoff in 2013. And what's interesting about Murphy USA is that they have this partnership with Walmart. So if you've ever visited a big Walmart in the South, like Mississippi, Alabama, Louisiana, then you've most likely encountered the Murphy USA gas station. As a matter of fact, if you have a Walmart Plus membership, which is their subscription service, that is actually not too bad, you get to save 5 cents a gallon at Murphy gas stations. So after you get done shopping at Walmart, you can pull right into the Murphy USA gas station and get your gas and save some money. So they have this partnership dynamic, and I wouldn't be surprised if Murphy USA is the one that supplies the gas for the Sam's Club pumps. But anyways, Murphy Oil, the company that we're talking about today, sells their raw oil to refining corporations and commodity traders. So that's their customer base. So when we think about like Chevron or ExxonMobil or Valero, those are the people that are buying it from Murphy Oil. And as you can see on your screen right now, the investor presentation, Murphy Oil, as of today, focuses on deep water and onshore drilling, mostly in North America and places like Mexico. And that's where their competitive advantage is. The concept of deep water drilling in the Gulf of Mexico is their thing. But there's a ton of players in the oil and gas field, to the point where I would argue there is no economic moat, except perhaps securing contracts with the US military, which happen to refresh every year or so. And I mentioned the DoD because they're one of the biggest oil spenders every single year, because their corporation, when you think about it, all of those jets, planes, and equipment, it requires a ton of gas to be efficiently training every day. So whoever gets those contracts tends to do pretty well. So I think we all understand their business model, how they make revenue, and that they are an upstream oil and gas corporation. Now, with that said, we are about to pivot to my most favorite part of the video. We're going to run some valuation models to figure out what the intrinsic value for Murphy Oil is going to be. So the first one is going to be the multiples valuation. Essentially, how the market views their market peers is how we're going to price Murphy. And as you can see on your screen right now, the PE ratios for everyone in the oil and gas field screams undervalued in traditional metrics. And I say that because the S&P 500 usually trades at around a 20 or a 24 PE ratio. And to have a company be below that, then, your spidey senses go off and say, whoa, this company might be undervalued. But no, my friend, that's because it's the oil and gas field. They historically trade at a lower multiple. But anyways, the median PE ratio is going to be 12.5, which gives us a price of $47 a share for Murphy Oil, currently trading for $33.50. I know I'm annoying, but I have to keep mentioning that because it's undervalued, even according to their peers. Next up is the discounted cash flow analysis model. Essentially, the free cash flow and their balance sheet is going to tell us how much this company is worth. Their DCF price is going to be $140.40 a share. Now, if Murphy Oil was a chips manufacturer or a CPG company, then yes, the $140 price tag would be warranted. But because it's oil and gas, this is a little too much. Even though I plugged in a very conservative 13% growth rate for the free cash flow, I still think their $140 DCF price is too inflated, and that's because they're an oil and gas company. Remember that. Next up is the dividend discount model. Essentially, their dividend and the growth thereof is going to tell us how much this company is worth. The intrinsic value, according to the DDM, is $128.40 a share, so it's kind of in line with the DCF price. The next one is going to be the Graham's valuation. Now, Benny Graham says that Murphy Oil is worth $81.63 a share, which brings us to the conclusion. Jimmy, you gotta hit them with the drum roll before we reveal the price. All right, friends, the intrinsic value for Murphy Oil is going to be $99.52 a share. Now let's go ahead and see what Wall Street believes the stock price should be. The Wall Street analysts think that Murphy Oil should be $46.52. So when we compare that Wall Street price to our multiples valuation, it's not far off, right? It's about $1 difference. So what I'm thinking is that similar to banks, I think when it comes to oil and gas companies, it might be better to value them according to the multiples valuation, according to how the market tends to price their industry peers. But anyways, we're going to go ahead and roll with $99.50 for now, just to do the first margin of safety acceptable buy price equation. So with a 10% margin of safety baked in, then the acceptable buy price is going to be $89.57 a share. Current price, we're just going to round it up and say 34. But if we move it 2 decimal places, then it's $33.50. I just don't feel comfortable with plugging in $99.50. So we're going to do something a little unusual. We're going to go ahead and plug in our multiples valuation instead of the intrinsic valuation of $99 a share. So at $47.64 a share as the intrinsic value for Murphy Oil, with a 10% margin of safety baked in, then the acceptable buy price becomes $42.88 a share. So to buy right now at $33 a share would give me a discount of $9. But let's go ahead and say, because oil and gas is kind of an icky investment because the growth is really slow, let's say we need a bigger margin of safety plugged in to make us feel better about this potential investment. With a 25% margin of safety baked in, then the acceptable buy price is $35.73. After reviewing everything, going through the numbers, looking at their data, the metrics, and looking at their history of doing some terrible financial decisions because they had to survive, what are my thoughts and opinions on Murphy Oil? Well, first and foremost, I think we got it out of the way early on in the video, but I do not think Murphy is a dividend compounder with cheese. It's not, because their total return tells a compelling story that it's really not. So I think of Murphy Oil as a stable dividend payer, because their dividend is absolutely sustainable and has plenty of room for growth, despite the fact that in their DNA and in their history, they do have a tendency to cut the dividend when they run into tough times. But whatever, I still see this stock as only a dividend payer because their top line has remained relatively flat for 10 years due to the nature of their industry. What I'm saying is that their days of growth are essentially in the past. But that does not mean that Murphy Oil is a bad company or a bad stock, because I think it's a very efficient company with optimized operations. They only have about 700 employees right now. So it's very lean. And when you think about it broken down per capita, they're hauling a ton of cash flow per worker. But on the other side of that, despite being a very efficiently run company, I don't know if you're aware, but most of the world's businesses and products are making a slow pivot from utilizing oil to now using sustainable energy like rechargeable and EV batteries, which means it's a direct impact on Murphy's line of business, right? If people are going to be using batteries instead of oil, that's going to really influence and dictate how much longer this company has left to be a contender on the stock market. But with that said, that's a doom and gloom way to say things. I don't think that transition is going to happen overnight. So I think Murphy Oil still has a place in business and economics for the time being, at least for the next 3 to 4 decades. Because when I think about all of the different countries around the world, not everyone has the capacity and the resources to make that transition overnight. I know the US and California is making that pivot very fast, but everywhere else, when I think about it, it's going to take time. So I think Murphy Oil is going to do okay, at least for the next 30 to 40 years. And so for that reason, I'm thinking of buying in at the right price of about $30 a share. And at $30, the PE ratio is probably going to be around like a 7. And I think my logic is this. As our high yield savings accounts are going to be declining because the federal funds is cutting the interest rates, I think for me, Murphy makes a lot of sense as a slow and steady dividend income to replace that 5 to 5.5% yield that we used to get. But I do want to emphasize that there's like 10 other companies that I'd be willing to buy before I buy into Murphy. But at the right price, it's not exactly the worst idea in the world. So Murphy Oil, not a dividend compounder with cheese, but it's not disgusting either. I would just label it as decent, a very average company. Remember, do your own research, do your own due diligence, because you might conclude that Murphy is beautiful. Or you might say like, dude, this company is disgusting. And with that said, I just want to call out that my beloved Seattle Seahawks are currently undefeated, and I'm in a really good mood. I couldn't have asked for a better start to the new NFL season. And on the other hand, my Tottenham Hotspurs are acting like a Premier League mid-table team right now, and it's not looking good. I will say this, their chemistry and flow is looking better by the day. Or maybe I'm just biased, but I think Brennan Johnson is picking up the pace and he's starting to get in form. So pretty excited to see what happens with the Spurs. Anyways, I hope you enjoyed this video and I will talk to you next time. Stay safe. Love you guys.